Yeah, thank you very much, Ting, for hosting that debate and taking the questions. Moving swiftly on, and we have to catch up a bit in terms of time, but the next panel we are hosting some companies that are more on the cutting edge. They are younger companies. They are spanning from financial services to credit rating to creating the world's largest mobile payment network to lending products. But they're all younger companies than some of the companies on this panel. To moderate this panel, we have also a friend of Concentric, Ivan Schouker, an illustrious career in financial services, and he's now advising a number of the largest financial institutions in the world on their digital strategy and their strategy on financial services. So he's well placed to moderate this panel. So Ivan, please enter the stage.
Morning. Good morning, everyone. Well, and I'm extremely privileged to introduce today an extraordinary panel of great personalities that are a mix of data scientists, engineers, and all entrepreneurs. And I would like to welcome, Virraj, Jatania. Oh, here, Virraj. Sorry. Aneesh, Varma. Aneesh, Jostein, Svendsen, and Frederic Nze. Who's Frederic? Hi, Frederic. Hey there. Well, I'm particularly privileged today, all the more that I actually have on the panel someone who's a co-founder of a business that I bought and ran for a few years, Jostein, who actually at the time, 15 years ago, we were actually bringing shares to people. Some of you may remember of this business called Share People, that objectives was fairly disruptive, getting rid of international stockbrokers and bringing international shares to the UK investor. So, great to see him in 15 years. I don't think he sat on a beach in the Caribbean islands. He'll tell us that it's opening a new 7th company quite soon. So, this is, as I was saying, an extraordinary panel. And I would call, a panel made of actually transformers. I would say transformers of tech-driven micro-lending with the co-founder of Oakam, Frederic. I would say a transformer of credit scoring with Aneesh. Transformer of the prepaid card, the best prepaid card, rated the best prepaid card last year with Virraj. And hopefully prospective a transformer of maybe community-based mobile banking with Jostein. I mean, clearly a casting worth of a blockbuster with Marvel. I'd like actually to start with the theme of credit scoring, which is clearly a clear enabler to a range of products and services that financially excluded or unbanked or underserved consumers face off. And I think Aneesh will have some perspective on reinventing credit scoring, and as again a key enabler of financial inclusion.
Sure. So our company, Aire, we're about slightly over 2 years old now. Strangely, the problem I'm solving is probably age-old. For me personally, I went through it about 9 years ago when I moved to the country. And it's interesting when I used to live in New York, and you had access to just about every single financial services. From there, when you drop down to zero, it really makes an impact personally. And for me, it was a difficult challenge. I Somehow managed to haggle my way into getting some of the banks to give me stuff. But it then became a personal campaign as well, and writing letters to MPs and writing letters to senators in the US. It was all fun, but didn't get much further than that. So what we've been looking at, and in that context, I can also explain, I guess, the wider problem we're solving. There are a group of individuals, largely growing in population right across the UK, US, and definitely much larger populations in emerging markets, who just don't have enough data that a bank would traditionally look at, right? So this is what the credit scores, the need for credit scores arises from. Now, there's three things that happen with these groups, right? One, the worst is you're completely denied, right? You just said, thank you very much, there's a door, carry on. The other category, which we start calling marginalized, is they either get a slightly more expensive version of the product, if it's a loan or a credit card, or worse, they're somehow like funneled into a different version of the product altogether. That doesn't even solve the problem that they were looking to solve, right? And I've always looked at credit scores, and maybe I'm allowed to say this, as the most boring thing out there, right? No consumer cares about credit scores. They care about the end product they get. They want a house, they get a mortgage, which is powered by a credit score. They want a car, they get a car lease, which is powered by a credit score, right? So tracking that history back, credit scores become quite a ignored thing, and rightly so. You know, consumers shouldn't have to worry about these things. So for us, in trying to solve that problem, we're also looking at how does consumer get involved at the point of failure. When they're applying and they're not able to get through, let's start working with them at that time. And second thing, and this is going to be a long, difficult challenge, is how do you improve financial literacy or even generally education around the concept of credit scores, debt management, because it's very easy for people to fall down a spiral. And then there's, I've met some companies, some of them in the audience as well, who are doing a fantastic job trying to recover. And I think those are partnerships we seek ourselves. But I think in the context of an introduction, maybe that's back to you.
Yeah, thank you, Aneesh. Well, let me turn to Frederic, because as a practitioner of behavioral and credit scores, unstructured data mining, in developing your business, how do you actually see bringing that data, relevant data, in actually enhancing your distribution of microcredit?
It's working, okay. Yeah, so the first issue we had is we actually had to develop a distribution network that was brick and mortar to enable conversation with our customers to capture the data that was not in thin files or it was in confused files. So we have two types of customers. We have customers that have very little information because they're new to the country, migrants, or they have a lot of information that's telling a confusing story because they were charged unauthorized overdraft fees and they didn't want to, they couldn't challenge it and ended up in default. So you have people who can pay a line very well and then have a few small defaults. So what we had to find is to gather information that is not in the credit bureau that enabled us to augment the quality of our decision. And our first step, when we set up the business, was to do it in a very old-fashioned way, which was to have a conversation. Yeah? We're now moving to, linking to the previous panel, using technology to change the way application forms are filled to gather open-ended statements around explanation around the credit bureau information. What we find is that most of the bureaus that are used today for, I would say, 80% of the market are working very well for middle-class consumers, actually completely failing the same way as we talked about product design for, how do you design, lending, prepaid card, etc., for people at the lower end of the market, so either working poor or migrants. We find that credit bureau and credit score are probably not designed for these customers. I'll take two elements. One is pricing, and the other one is actually what they're trying to forecast. On the pricing side, today to get the information we need to underwrite a £200 loan, let's say if you do micro lending in the UK, you can do £200, £500 loans. You actually pay the same amount for that bureau report and for all the things around for ID check and everything that you'll pay for a 7,500 loan or much larger loan. The actual cost of transaction of getting that information represent, so let's say if you were doing £200 at 10%, if you try to do a 10% APR loan, £200 over a year, you actually get only interest of £10. Paying £3 for a credit report is 30% of your income. The £3 on the 750 7,500 loan is 0.7% of your income. So the first issue is that actually the poor customers are paying more for everything, including access, because of the pricing structure of the credit report. The second thing we looked at, we've just finished a study with Sussex University and LSE around how the fact that there's no specific category for micro-lending in the UK mixes payday lenders with micro-lenders. So we're seeing people who are coming actually on the way down. So they've had credit cards, they had home equity loans, etc., and they end up using a payday loan because they're struggling with their finance. These customers have on average £25,000 of unsecured lending. They're treated the same way as a customer who only have £1,000 of short-term lending, micro-lending, so small loans. And as a result, it's like they're disqualified for being graduated to mainstream. So we have a lot of customers who come to the UK, migrants, who are perfect payer, but because they're using a product that is deemed by the mainstream market as a high-risk product, they get disqualified. So this is the second issue we have, is like actually the reports are not creating, the three bureaus, the main dominating bureaus, are not creating a category specific for micro-lending. The last piece, I think, is, you talked about enabling other data to being taken into account here. I think we need to find a way to make transparency of the bureau and challenge the bureau easier for customers that are not financially literate. A lot of the customers who come to us and with whom we have conversation have no idea what is on the bureau and no idea how to challenge it. So when we present the information, because of issue that was raised by Sean earlier, around people sharing account or taking a loan for someone else, we have people who are happy to challenge what is on the bureau, but they have no idea of how to do that. So I think we need to find a way to get unstructured information, social data information, but also challenge to what is currently out there in a way that is very opaque and working well for the mainstream.
Thank you, Frederic. Virraj, on this particular sort of search for actually the right data, your experience in actually, investigating new distribution channels, in the prepaid space, has, brought you new learnings about how to design your products related to actually the information you collect, the type of segments, and, not necessarily the segments you would expect. What is actually coming from your learnings of having launched that prepaid card in that regard?
Yeah, yeah, sure. So recently we've been sort of expanding our marketing channels and our customer acquisition channels to be beyond sort of traditional online channels. What we've really found is that that's where a lot of our target customers will sit. They're not transacting online, looking online for their financial services solution. We've done a number of different initiatives on this space, but one which I think was as recent as a couple of weeks ago, which was extremely interesting, was a direct response advertisement that we did in a major national newspaper. Believe it or not, the way people can acquire our account through that advertisement was either by filling out a coupon in the newspaper, so they tear it out, send it in to us by post, calling a telephone number or signing up online. And we saw a massive uptake of the telephone number and people filling out a coupon and posting it into us. So that was one thing that was quite interesting. The second thing that was probably even a bit more interesting, and one of the things that I have subsequently challenged my team to now find a solution to, is that of all the applicants, of all the calls and inbound traffic that we received, we weren't actually able to process 50% of the applications because none of those people had email addresses. They only had mobile phone numbers. So you have to start thinking about the delivery of these products in a slightly different way. And I think it starts to explain to me as a founder and the CEO of the business and the rest of my team that we really have to understand how this customer lives their life. And it's very, very different to a traditional consumer that, or the way that we all do things. And I think one of the big challenges is kind of, as a business and as a team, how do you put yourself into that mindset? And so that's been one of the most amazing learnings that we've had over the last couple of weeks. So
thank you, Virraj. And continuing on this introduction, maybe with Jostein, who's actually working on a on that mobile delivery channels, but also with a community orientation. What is your current thinking in creating a business that fits or respond to some of these observations?
Yeah, and I'm actually very grateful to be here today because all of the problems that have been discussed is actually the reason why we set up our company. Because we see that the old traditional banks and the old way of doing the business, the outdated credit scoring systems, the old IT systems that are not flexible to do international banking at low cost and so on. That's the reasons why customers are turned away. That's the reason why customers are charged high fees. And we think that if you're going to be successful in doing financial inclusion, you need to start again. You need to start with a clean sheet. And that's what we are doing in our bank. We are actually building a bank not only for financial inclusion in the UK, but actually globally. You can think of us as a global M-Pesa with free money transfer, but also with the lowest interest rates on lending that you can see in the market. Because financial inclusion is not just about getting access to pay your bills and transfer money, but it's also actually to be able to lend that extra money at low rates, not that extortionate rate that is typically happening today in the financially excluded market. And we see the problem here in the UK. We have heard some numbers, 10, 15, 20 million people in the UK. I started working on this business plan. I was CEO of a software company in Silicon Valley, and so 40% of people in Silicon Valley were born outside. Arriving in Silicon Valley, you have a job for a well-funded startup, but you can't get any loans there. But in the US, actually, 1/3 of the US population are financially excluded, more than 100 million people, and globally, 2 billion people without bank accounts, but there's probably 4 billion people who don't get access to socially responsible lending. So it's a huge problem, and we think to solve that, you need to start again. You need to start from scratch and think completely new. And yeah, so I'm super excited to be here. But by the way, we are a brand new UK-based fintech startup / hope to be a bank. We incorporated the company a few months ago. We are at level 39, and we hope to start talking to the Bank of England in the next few weeks about getting a license.
Fantastic, Jostein. Thank you. Well, on actually this growing, in some ways, the size of this financially excluded or actually marginalized market is an observation that Aneesh and I just talked about before, in the saying, is it actually a market, a redefinition of work, and actually the way actually people are being paid, the growth of the Uber economy and the self-employed and so on, is actually redefining the relationship with the purchase of financial products. And this is where the high street banks simply just haven't picked up, right? Or are not structured to actually be able to deliver. What actually, through the credit scoring, the analytics that you're going through, what observation you have on that new economy?
Yeah, it's a good point. I didn't realize how big self-employed freelancers, contractors, how big that sector was when we started this, but we're seeing over a quarter of the people who end up scoring are in that bracket, and it's shocking, and only rising if you think about where the economy is headed, right? And it's, as a guy who we scored and we ended up having a feedback chat with, and he worked for a bank in their IT team, where if you think most banks have forced their IT contractors into a self-employed contractor mindset, and that particular bank itself was unable to score them. And the guy had worked there for 6-7 years. It was embarrassing almost for the other bank to be sending a customer to us. But there is this trend and evolution that we're all seeing, right? So I don't know how many of you have ever taken an Uber car, and if you actually end up talking to the driver, just within that microeconomy that he operates, he has to get the car lease at a certain weekly rate for the whole Uber economy for him to work. And he has to drive, I don't know, 6 days, 10 hours, 12 hours a day, right? And if the leasing rate increases just a bit, the amount of hours is not going to change, but his take at the end of the week or the month is shrinking and shrinking. All of a sudden, these guys are going to be like, there's no point for me doing this. I might as well do something else that doesn't have this financial burden on me that's getting progressively worse because my situation isn't allowing me to move over. And these anecdotes are only going to grow in this economy that we're living in. Job mobility is increasing. People change jobs by the time they're 40 a lot more times than they did back in the 50s. The concept of job for life doesn't exist. So a lot of our work's also been looking at the original, let's say, FICO-based credit scoring model, which is the term more popularly used in the US, but largely similar terms around the world. They had a couple factors that made sense in the 50s. There was limited data, there was limited computing power. And the biggest thing was you didn't have the ability to go back to the consumer in real time. It had to be almost done with the user not being involved. It's like writing a CV or a resume, and the guy who it's being written for gets no input in it. It's horrendous. So I think that mindset, if you start shifting, and there's a lot of interesting inputs a consumer can provide themselves. One of the big things we are really focused on right now is trying to understand character. Very, very hard to measure, short of putting a human being in front of the applicant and maybe running a 20, 30-minute interview, which used to happen back in the day when banking was still personal. But I think that evolution has also showed us, and in our case, AI allows us to do some of that. We're not perfect at it. I think there's a great amount of research we still have to do. But what's happening now is we're able to see, okay, the hard data, your financial metrics and your income streams expose one thing, but the character layer can really influence a direction, right? And it doesn't have to be that if somebody's a low-income person, they're going to be bad at credit. If your character's there, you're going to come through. You're going to make ways to make sure you pay down your obligations. So for us, that's a big part of opening up a different way of looking at the same individual. I know, Frederic, as well, you guys run a lot of manual interviews with every applicant, right? And I remember hearing your case study, and I was like, that is amazing, because that audience you're trying to serve, the data will never tell the full story till you get involved and speak with them. So I think those kind of mindsets have to be brought in.
Absolutely, and actually I'll talk to Frederic, because we could argue we go back to basics of banking, but with actually obviously more modern tools. But your business model, Frederic, sort of based on boutique managers that actually have an important input in following the risk and the characters and so on. Could you explain us how that model of actually grassroots, boutique-based delivery is actually quite important in your risk management, right?
I like the term boutique instead of branches. It sounds much nicer. But we have. It was interesting when we started the business. We were looking at where do you need service in financial service, and what we found out is actually it was needed in the ultra high net worth, and then at the other end with people who were excluded. So either poor people or migrants. So this is where people are happy to pay for service. But that high-touch model, when you do it on very small transactions, is quite expensive. So you mentioned risk. We're talking about information to gather to take a risk decision. But actually, when you look at our economics, risk is only half of operation cost. The biggest driver of high-cost delivery of micro-lending or microfinance is actually transaction cost. So information gathering, payment processing, the fact that you have to design products that are more attuned to people's lifestyle. So for example, we don't do monthly direct debit because our customers prefer to pay weekly. So majority of our customers are on weekly payments. The payment infrastructure, as was highlighted in the previous session, is again charging unit cost for that and creating issues and raising the cost of delivering transaction to these customers. So we looked at the boutique, as you mentioned, so the branch manager, et cetera, to always select the processes where human intervention adds value. And over time, as we gather information about customer, we're shrinking it to try to move everything on mobile so that we can deliver cheaper and cheaper services to customers. So to give you an example, information that we gather through story in the store, important, but as important, we found that gamification and dynamic incentive given to customer as they operate their product, influence customer behavior. So designing product where you have no penalty for late payments, designing product with flexibility, because we know that our customers, if they're on 0-hour contract, will be able to pay 3 weeks, and the 4th week they'll have no cash, so we have to create that flexibility. So the product design and the incentive to keep the relationship was as important as capturing the information at the initial stage. So what we're finding is we needed to jumpstart the business with the boutique, but gradually our customers are quite technology savvy and they're happy to use the mobile for a lot of the transaction, and they know that it's cheaper for them. And we're doing a win-win deal where if they move to that mobile transaction, we're reducing the price for them. So that's a little bit of the story behind what we've created.
actually gamification is becoming actually a key word. Some of you may have heard of serious gaming in terms of education, in terms of introducing, it's used actually by compliance increasingly. Virraj, the gamification is a theme that you've looked at. In the card business, one could argue that American Express, which I've been part of in the past, and Frederic too, I understand. The gold, silver, green is some form of gaming, right? Of segmentation, right? How do you see gamification as a tool of education, of actually helping the consumer to look for what is for its own interest?
Yeah, I think slightly differently to Oakam and businesses like that. We service our customers at the very core level of their banking requirements currently. So it's really about them depositing their cash or their salary checks with us, and then being able to transact, pay bills, and make regular payments. So what we've actually found is that at that level, gamification isn't actually that effective. So again, our customers are fairly on the sort of less financially savvy side of things. So what they really want is something that's very, very simple, very easy to understand. It's kind of black and white, and that's it. And they don't have to sort of start thinking about how do they use the product. So we've actually found that having different tiers and doing certain things to achieve a slightly, maybe a slightly better price per ATM withdrawal, for example, whatever it might be, is not actually massively effective. But where we do think that there's a really interesting development that needs to really happen in this space is around financial education. And I think that one of the biggest challenges I think I would sort of throw out to all of us here is that how do you actually build in a financial education element into your business if you're servicing a group of consumers who are on the sort of underserved, unbanked side of things? Because the only way for them to graduate up and to become financially savvy is for them to have, one, a good experience, but also to learn about that experience and to keep improving and to keep getting better and to understand what they need to do to get them up that ladder. And so I think that that's one of the more important sides of things that we would be looking to focus on.
Jostein, you've looked at some of these aspects from a social, peer, friends and family community orientation, not only actually important from an education standpoint, but also for more effective risk management and more effective marketing. How would you actually see that as a key premise for your business?
Absolutely, because even if you are financially excluded, you probably have somebody in your network that are included. And then you can actually tap into the ability of your social network, especially your friends and family. Those are the first people you go to. Actually, statistics are showing that 70 people, they borrow money from friends and family, not from banks and card companies and so on. That number is in the 10 to 20% range. And then when you think about if this is now happening informally, if you can actually formalize that process, that can actually go in as input into start building a credit score. Even if you don't borrow money from a bank, you borrow money from a family, we formalize that on a mobile app, we generate an IOU, and that will then start building you a score, so you can build a reputation score, both as a lender and a borrower, or think as an Uber driver, both the passenger and the driver get ratings. So we are looking at doing the same. And then we can use that as a part of the underwriting for us to issue a loan or credit to that person. So even if we don't know that person and that person had no credit score anywhere else, we can look at many other factors then to help them up the ladder. And it's interesting. You talk about the ladder, but you said you didn't want to use gamification. We want to call it gamification to help people up the ladder, and we have coined a term which we call progressive financial inclusion. That means that the person in the network which is included can basically stretch a hand out to you and help you up that ladder. And then by the time you're up there in the center and included, you can stretch your hand out to help somebody else. And we think the network effect of that is tremendous, and this is at the core of our strategy to basically make a globally financial included world.
No, thank you, Jostein. In fact, it actually goes pretty close to one of the questions I've just read. How can we help the unbanked transact money among themselves? I mean, this is almost like community banking into social banking, social network banking. You know, Frederic, do you want to cover that, maybe? Yeah.
One of the things, you know, so I'll bounce on what Jostein, you pronounce it? He has just said. But one of the things we've been working on for now a good 9 months is looking at how we're pooling the resources of our customers together to enable them to access cheaper services outside financial service. Because the idea here is we know that they're all paying this poverty premium on every utility, even when they're buying white goods, et cetera, et cetera. Some of it is linked to lack of education or lack of confidence in, you know, reading the small print in certain things, or just no ability to secure the one-off fund to make a large transaction. So you know, here, one of the things that will be interesting is not necessarily doing transaction within them, but actually pulling the money, the way it's done in traditional rotating saving association, to actually purchase things at a cheaper rate. Yeah? The pooling or vouching is something we've done for now a few years, and it works very well. One of the ideas that I think could be quite interesting for Aire is looking at how you formalize, without doing a guarantor loan, you formalize the link between two borrowers, one with a high credit score and one with a low one. So the traditional one will be parent and children, but also we have it for, you know, in our customer base with migrants. So we have the first customer come to us and they've proven their payment behavior. If they bring a friend who just arrived from Poland or Romania, we don't score them the same way. We score them using the behavior of the previous customer, and we found it very, very relevant. And it creates kudos in the community for that person who has made payment. We reward them for that. But also, you know, they become like the entry for the community and reduces our marketing costs dramatically. We've been running at acquisition costs that are a fragment of what some of the short-term lenders are doing in this country, thanks to that, because of the community element. So I think pooling is an important one, and you know, it's not necessarily just peer-to-peer.
Yeah, I completely agree with you on that. That's a core part of our strategy. The other one is to remove the fees. And we did that in Norway already 14 years ago when we launched the first digital bank in Norway. We were the fastest growing bank in Norway. We managed to capture 120,000 customers in 3 years, and we had only 14 employees. And by running the bank so much more efficient than anybody else, it meant that we could have 0 fees. So actually our website was gebyrfri.no, which means no fees.com. And that's also how we think. If we can enable transactions, paying bills, transferring money anywhere in the world, especially if you're a migrant, you want to send money home, if you can do that for free, and you can even help that uncle back in India to get a loan at the same rates as you can get in the UK, then we have made a tremendous step forward.
That's fantastic vision. Should we turn to the audience for some questions? Yourself? Sorry. Here you go.
Good morning. My name is Jorge Bolivar. I run a family foundation in Spain, and I would like to really congratulate the people here and to share an experience about community lending. We work with poor and extremely poor people in Guatemala and Peru and Ecuador. We go to their communities and we convince them that they should save long term. Their first answer is they cannot save because they're very poor. So we tell them, no, you only need financial education, as Virraj was saying. We are going to train you. The only thing you have to do is you have to come together, 10 to 30 people, where there are bonds of trust. We will train you on how to save regularly money. It can be $1 to $2 per month, and how to lend it internally. And just to give you an example, in Ecuador, right by the place where the earthquake took place, we have a group that started November 2014, 18 people, less than $200 they were able to put on the table. There is no online thing. It's all about physical money, right? So they put less than $200. 1 year later, because they distribute dividends once a year, they commit not to take away the shares they buy, because they save by buying shares. And using the word shares, just by using the word shares, everything changes, because a share is part of a property. So they own part of the group, Okay? So they buy shares that they commit not to take away. They only take away the dividends once a year. 12 months later, I was there in the first distribution meeting, and they had saved above $4,000. We are talking about people living under $2 per day. So that is considered extreme poverty. No fixed salaries. They were fishermen. They rent a room, or they just cook and sell what they cook. So they had made over $4,000, and they distributed $2,000 dividends. And you know what they do with the money? 75% of those dividends, they don't take them away. They buy more shares. So that's to say that I think it's about financial education, it's about trust, and talking about credit ratings. Credit rating, when there is trust, trust replaces credit rating. So why do they lend to each other? Because they know each other. It's my father, it's my son, it's my friend, it's my neighbor. Okay? And that's the way it works. Now, last year, it was like October, I was thinking about how should we bring this, not to the unbanked people, but to Europe, to Spain. So I came to one of our companies, which is a financial advisor. They are engineers, economists, whatever. They have a salary, but they have also the need. So we have created a saving group, and now they don't ask for loans outside. So when they have to buy a car, or they have to pay university or MBA, they ask for the loan inside the group. We save at 6% per year. We lend at 6% per year, which is, 6% is great when you get zero at the bank. Okay? So well, that's just to share an experience. It's about financial education for us. I'm trying to answer that first question. And it's about trust. Okay? It's rebuilding trust, which is something difficult. Thank you.
Thank you. There was a point of the peer-to-peer lending. Actually, there was one of the questions here. It's opportunity, but also potentially it's risk. Anyone, Aneesh, do you want to answer that on peer-to-peer lending?
That's a good one. So the way I look at it, right, any new financial company coming in and trying to create its own space, our space, your space, I have this belief with finance, you're dealing with a real-world problem, right? So as a company grows, you're going to run into more crossroads. And the company that's going to win in any space, for financial inclusion, for everything else, P2P, is the one that's going to be able to balance all these crossroads most effectively. It doesn't mean the company with the biggest balance sheet, the biggest data set, the smartest PhDs, whatever else you're sort of stack up. It's going to be balancing the regulator and the partners and the media and the consumer trust and making sure your technology is scalable and making sure you have all these other crossroads that you're sitting on, you're winning, which does mean you will have to make compromises on something. But ultimately, it'll be a solution that everybody gets around and everybody loves and everybody is happy with. Because I see this with my problem. I'm sure you guys are doing it in your own businesses. But when it comes down to P2P as well, I think the incentives today for some of them aren't really aligned towards financial inclusion because, let's face it, they have a reputation to keep. And that reputation typically means you lend to the AAA and the guy above the AAA. And anything that starts sliding down the spectrum, you start running away from. And even if those people have good character. And part of that is also with the pressures they're probably getting about having to go list on the stock market. And our friends at Lending Club are having a fun time with that. So there will be some challenges, and therefore that sector perhaps hasn't been able to drive the right compromise amongst all these balancing forces. So I'm happy to hear otherwise. I'm still not very confident that P2P on its own can go handle financial inclusion. Just the way their incentives are geared today, they can make a good attempt, and we're happy to help, but the status quo is going to have to change.
Jostein?
I think helping to formalize what is now the informal peer-to-peer lending between friends and family, that can be very useful. Because like you said, the for-profit peer-to-peer lenders, they're actually more conservative than the banks. Some of them are. And they are really not financially inclusive. So, but some of the reluctance that are between friends and family is that you very often know that you give a loan, very often it's not formalized, when it's going to be paid back and so on, and you hate on calling on your friends and family and say, please, can you pay me back? So since it's not formalized, maybe a lot of loans that maybe could have been given can actually then be released if they know, hey, here is a mobile app, I can transfer money for free anywhere in the world, And together with the mobile app, before the money is released, the person has to accept the IOU, the terms of that loan. And they can all be managed by the mobile app. And the mobile app will actually remind your friend who borrowed money from you, hey, remember, you have an installment coming up now. You agreed a loan over 6 months and pay every 30 days. And the mobile app will take care of it for you. So this is, at least in theory, we think this can help to release a lot of power. And it's not done for profit, actually. In our case, we do it because we just need that data to make better decisions, better understanding of our customers.
Thank you. I think I'll take maybe the last question in the back. Sorry. Go ahead. Sorry. Go ahead.
Thank you. I'm Hans Olav Eldring. I advise investors who want to invest in fintech. You mentioned before, I don't know, remember your name?
Aneesh.
Aneesh,
Yeah.
yes.
The example of the Uber driver who has his profit or income threatened by increase of the loan for his car. But as we know, we're living now for 8 years on an ultra-low interest rate world, which is unseen, and obviously it's not going to be for the next 10 years. We don't want to speculate, but it's going to go up. So do you see that as a threat for your business? And if yes, how would you address it?
For our business, I think despite any credit cycle, credit's going to be part of our lives, right? People are still going to buy mortgages. They're at 15% or 3%, that market still exists. The individuals within that obviously will have to adjust, and it makes it even more important for us to get scoring right. I mean, I love the example of mortgages, right? I don't know how many of you realize that about a quarter of the mortgages in the UK are mortgage payers are overpaying, and roll that forward 25 years. That's a good amount of money that the family has lost that could have gone to health for their kids' education. So, importance in making the right decision up front is quite important. Where we can help that, I think it helps. Going back to the Uber drivers, the same story, right? Most of them, if interest rates start rising, like back in the Volcker days, these guys are going to walk. So it becomes a challenge for Uber, but also it becomes a challenge for any, let's say, auto finance company, because they're going to lose a heavy chunk of their market. Therefore, we'll have to get into smarter scoring to see, can somebody still get the best rate or pseudo-best rate that they have offering? I don't know if the rest of the panel has a view.
Any observations on top of that?
Yeah, it was mentioned about the contracting and freelance economy currently is maybe at 25% was one number mentioned. I heard over the next few years it will actually become the largest portion of the employment, 40% will be on contracts and so on. And that's a huge challenge because the banks don't necessarily know how to deal with the customers who are not on a payroll. And to actually solving that, and Uber drivers is a great example. I remember I was shocked. I stopped by a car rental company that also had a leasing program. And they were leasing the Toyota Prius for £1,000 a month. I don't know how much you as a normal premium consumer can lease that car for, but it's probably in the £200-300 a month. So can you imagine the Uber driver having to pay 3 times more just because he doesn't necessarily have the right credit? So solving that problem for the gig economy or the contractors, freelancers, Uber drivers, Airbnb hosts, it's a major opportunity.
There's something about making data portable, so cross-border and also within, outside financial service to bureaus. Because I think what you're mentioning here is people who can establish some element of payment pattern that is not recognized anywhere and they end up overpaying. 50% of our customers come from another country where they, a good chunk of them have a payment history. And if a company like Aire could have like almost a passport credit history across border, that would be fantastic. But I think, similarly on, prepaid card is, you're finding it tricky to, all the transaction costs are creating friction, but actually the data is very interesting. Yeah. But that data has value only if people can use it for other products. Yeah. So there's something here that I think will help resolve that issue.
Indeed, the next frontier is indeed these global nomads, or which used to be privilege around the folks going from airports to airports, now becoming a migration, low-income, sort of mobile, cross-border type of segment, which I understand some prepaid businesses are looking into as well.
Yeah.
Right?
Well, I mean, so you can passport through Europe pretty easily. with the SEPA sort of licenses. So you can go cross-border in a very, very sort of straightforward way.
I'm sure you would love to actually engage with this panelist during the break, because I think I'm taking a little bit on your coffee break. So, but wanted to thank these transformers, and I wanted to have you applaud them for and encourage them for their entrepreneurial passion.
Actually, before we break, sorry, I'm shouting a bit there. We're going to do a few questions, which, if you all pull out your Glisser apps on the phone, the question, there's, I think, a couple of questions. What are the biggest barriers to financial inclusion? So, effectively, if you just select all that you think that apply on the app, and then, as you can see, is the magic of the pie chart will hopefully give us a conclusion. And I think, is that polling done on that one? So the biggest one, you probably can't quite see it, but it's kind of like, oh, hold on, it's changing. So the biggest three are lack of internet access, traditional banks application procedures. Oh no, it's changed again. So the winner actually now is lack of internet access. Joint second is traditional banks application procedures, and also I think that actually appears twice in the question, so apologies for that. So third would be, or joint third. Yeah, I can't actually see what the blue is, so apologies for that. So I think the clear message there is obviously the internet. Oh, actually, yes, we moved it up, and then third is low pay. So I think we're going to move on to the next question, if that's all right. And a bit shorter this time, as I know you all want some coffee. Do you believe the fintech sector can play a major role in promoting financial inclusion? So if you just want to select, I think, one of those options, and then we'll... I'd assume that's the correct assumption, whoever said that. So there's quite a strong message there. So with that, I think tea and biscuits, coffee, water, juices are all outside. We're going to come back in, I think, 14 minutes. At 10 past, actually, so 24 minutes. So see you then. Thanks, bye.